I think we're ready. Let me try.
Okay, we can keep this relatively open. So if you have questions, let me know. But what I told Abby I would do is talk a little bit about tax planning. We certainly talk in this context about record keeping. I also want to touch on loans for beginning farmers and ranchers just briefly. I have a little information on that, but we can address other topics as well. And at the end, in case you're interested, I'll talk a little bit about entities. So let me go ahead and start here. Uh, first of all, I've got several different topics I want to discuss here. Just touch on. There is some very good information that's available from the IRS, believe it or not. There's a farmer's tax guide. If you haven't seen that before, that's very useful for small, medium-sized, and large farms to look at how taxes are handled from a farm perspective. There is some laws that are specific to farming, and so that's well worth downloading from the internet. It is about 80 pages. That's not something you're just going to read from beginning to end, but certainly if you have a question on deductibility of a certain expense, by all means, take a look at that. I'm just going to hit some of the high points today in interest of time. The first thing I'm going to talk about is accounting methods. Then I'll talk about income and expenses briefly. Talk about not-for-profit farming. You certainly don't want your farm to be classified as a hobby farm because then you can't deduct expenses near as much. And so I'll talk a little bit about that. Talk about self-employment, employment taxes briefly. And then if we have time, we'll talk a little bit about business entities and state taxes. And so I'm just going to touch on all of these things. Most farmers, if not all farmers, use the cash method accounting because they find it easier to keep records. And so in your record book, you want to make sure that you have accounts that are similar to the accounts listed on the Schedule F. And so I'm going to have that on another slide here. That's a minimum number of accounts that you want to keep, or a minimum amount of expense categories that you want to keep. One of the things you definitely do not want to do when you're keeping records is you do not want to lump all your expenses into one or two categories. That's not a good idea because IRS does look at that information and they start scratching their head saying, why did 80% of their expenses end up in supplies? That doesn't look right to us. And so make sure that you appropriately put the expenses into the categories that are on the Schedule F. That's at a minimum. You can have more categories than that and then aggregate up to the categories in the Schedule F. But you should try to keep track of your expenses well enough so they fit into those major categories that are on the Schedule F. The reason why farmers like the cash method accounting is really quite simple. It gives us a tremendous amount of flexibility in when we report gross income and when we can deduct expenses. The previous speaker talked about cow-calf operations. An example of that, let's say we have a spring calving herd and we don't know for sure whether we want to sell our calves in the fall or in the spring. Well, with cash basis accounting, you can actually, if you sell your calves in the fall, you can report that income that year. If you retain the calves to the following spring and sell them as yearlings, for example, you will not have to report that income until the following spring. Or you can sell some calves in the fall and some in the spring. And so it gives you tremendous flexibility in terms of when you report your income. You don't have to report income until it's actually received. That's much different than the way a large corporation would have to keep track of their accounts. They could not use this method of accounting. Any small business with gross income under 25 million, so even your individuals that are in landscaping business, for example, can use the cash method of accounting, and that of course includes farms. Also, you deduct expenses in the tax year you pay them. And so let's say you have you're planting corn next spring. If you buy all your seed in the fall, you can deduct all your seed expenses in the fall rather than waiting to deduct that in the spring. So it just gives you tremendous flexibility in terms of reporting income and deducting expenses. And so you definitely want to use the cash method accounting, which also fits your account book quite well because that's all cash for the most part. In terms of what's farm income, the main items, of course, is the obvious things: sales of farm products, agriculture program payments, any conservation program payments are income, crop insurance, disaster payments, patronage dividends from a co-op, any custom work income you might have. If you go ahead and bale some hay for a neighbor, that's included in income, and the expenses from doing that operation, the baler repairs, the fuel, the depreciation, interest on the baler and the tractor, that's an expense. And so there's no big surprises here. The important thing is the income is only reported in the year you actually receive the money. And so that's because of the cash method of accounting. These are some of the primary expense categories on the Schedule F. And so this is the minimum amount of categories that you want. Again, you can have much more detail than what's on this slide in terms of your categories in your account book, but you at least want to have at some categories, as I indicated, so that all your expenses aren't in one or two items. You have to be particularly careful that I don't have supplies listed here, but supplies is also a line on the Schedule F. You have to be particularly careful that you don't try to put most of your expenses in supplies. And so if you have repairs, you have fuel, you have seed, you have fertilizer, that you put that in supplies. Do not do that, because that's a red flag to the IRS. They're looking for rules of thumb like that. That's one of them they look at, is if it looks like you don't have your expenses categorized in very much detail, that'll increase your chance of being audited, which of course we don't want to happen. And so use at least some accounts and try to appropriately put your expenses into those accounts. So just a word of wisdom there. One of the expenses I want to talk a little bit about here, of course, is interest. And while we're talking about that, let me talk a little bit about beginning farmer and rancher loans. If you qualify as a beginning farmer, you'll have to go to the FSA office to find out for sure whether you're qualified as a beginning farmer. But the rules are fairly loose. Essentially, if you've operated a farm for less than 10 years, you participate in the operation of the farm, and so you're involved in the farm. That's a couple rules. There's also some rules about land ownership, which if you don't own any land, that's that's resolved. If you own some land, there is some rules related to how much land you can own before you're classified as a beginning farm. But the definitions are fairly loose, and the advantage of being classified as a beginning farm for loan purposes is the interest rates are substantially lower. So if you were going to get a real estate loan with USDA FSA, the interest rate would be substantially lower, several percentage points lower, in fact, and the amount of down payment would be really small compared to what a lender would require. And so that alone is a reason to look into this if you haven't looked into this already. Also, there is also operating loan money available for small, for beginning, I shouldn't say small, but for beginning farmers and ranchers. You could be a beginning farmer or rancher that's associated with a large farm, but you're just starting the business, and so they're going to help you with an operating loan. They're going to help you with a real estate loan. Perhaps there are loan limits on these things, but as I said, the interest rates are quite low on these loans, and it's particularly attractive for the real estate loans. If you don't own any real estate or own very little real estate, and you're thinking about buying some land, this is a good program to take a look at. I'll talk a little bit more about that in a few minutes, but I at least wanted to mention that while I was talking about interest. Here's a big item that we need to think about when we're looking at expenses. Prepaid expenses are expenses that are incurred in the fall, for example, for a spring crop. Or if we buy feed that we're going to use in the next year, let's say we bought feed in the December of 2020 that we're going to use in January, February, March of 2021, that's called a prepaid expense. Why is that important? Well, first of all, IRS allows us to do this. And so if we have a lot of income, if we had a lot of income at the end of 2020 was a pretty good income year for a lot of farmers. If we had a lot of income at the end of 2020, we could buy feed for next year. We could buy seed and fertilizer, other farm supplies in 2020 that we're not going to use for 2021, and we can deduct those expenses. And so that's extremely powerful. you have to be careful here on the prepaid expenses. You can't get too carried away. And so if you have a relatively small farm with a small enterprise, you got to be a little careful with this. You can only deduct up to 50% of the expenses for the year. That's pretty easy. That's pretty easy to meet that criteria. But just something to keep in mind. You can't buy all your expenses for 21 in 2020, but you certainly can buy quite a few expenses for 2021 and 2020. And the only reason I mention this again is this is a way to control your income or to stabilize your income from one year to the next. If you're going to do these prepaid expenses, any lender you work with is going to want to make sure you record these expenses on the balance sheet as a prepaid expense. And so think of these as supplies, if you will, but don't categorize them all as supplies. Categorize those appropriately as feed, seed, fertilizer, or fuel, or whatever the supply is. But think of these as inventory or supply inventory, and so you want to make sure that's on your balance sheet. A couple of other expenses that are very important from a farm standpoint, and I give 2-hour lectures on this particular topic, so we obviously are not going to give an hour lecture on depreciation. It's one of my favorite topics. I just asked my students here at Purdue. But the only reason I mention this is there's a lot of ability to deduct assets in the year you purchase them. The tax code is very amenable to small businesses in general, including farms and ranches, which almost all farms and ranches by IRS definitions would be a small business, believe it or not. Anything under 25 million from an IRS standpoint is a small business. And so we can use the modified accelerated cost recovery system. That's your typical tax depreciation. It's not straight line. It's somewhat accelerated. That's our standby. And so if we bought a new tractor, for example, this modified accelerated cost recovery system would allow us to depreciate that tractor over 5 years. If we bought a grain bin, it would be 7 years. And so each asset has its own category in terms of how many years you can depreciate that asset over. If we want to accelerate the depreciation above and beyond the makers, we can use Section 179 or bonus depreciation. And so let's say in 2020, we had a real profitable year and we wanted to buy a used baler or something like that. And so we can afford to buy the baler. So that's already been resolved in a different analysis that we can afford to buy the baler. And so to reflect the fact, to reduce that large income we have in 2020, we can write off that baler using bonus depreciation or Section 179. Bonus depreciation is 100% for 2020, 2021, and 2022. And hopefully they'll extend that, but I wouldn't hold my breath on that with the new administration. But the 100% means that I can write off that asset completely in the year I purchase it. You don't necessarily want to do that. You only want to do that if you have a lot of income, but it gives you the ability to do that. The Section 179 allows you to write off up to $1.04 million in machinery. This is depreciable assets, not land. But depreciable assets in 2020, this is indexed for inflation, so it'll be even higher in 2021. And so obviously, these allow you to do some tax planning, particularly as you're growing. You have the ability to really depreciate assets very rapidly with these depreciation rules. Now, if you don't have a high income in 2020 or 2021, you wouldn't want to use Section 179 or bonus depreciation, but they're there if you need them. There's another deduction that's very important, and this one also we could spend a lot of time on. I've given the last couple of years, I've given an hour lecture on this in the tax schools. We do have tax schools at Purdue for tax professionals. Hopefully your tax professional goes to our schools. But the qualified business income deduction is another deduction we can have as a small business or as a medium-sized business. And this essentially lets us deduct 20% of qualified business income for a sole proprietor, partnership, S Corp, LLC, everything but a C corporation. C corporation had very large reductions in their tax rates in 2018, so That's why they didn't qualify. And so this is just like an extra deduction you get, if you will. There is certain things that are not included in qualified business income. The one that's really important for farms is number one, any gain on selling machinery or land is not included in qualified business income. Therefore, is income we cannot deduct, but certainly sales of grain, sales of livestock, we get this extra deduction, which is large. 20% is huge. And so that's just an extra deduction we get because of the tax code that started in 2018. Another one that does occur for agriculture is number 4, commodity gain or losses also are not included in qualified business income. And so this is just something to keep in mind. In addition to depreciation, we have this qualified business income deduction that's available to basically all businesses that are not C corporations. Here's an example of how powerful this is. Brandon Smith earned $100,000 qualified business income as a sole proprietor. So that's after he deducted expenses. He got $100,000. He sold some land and recognized a $50,000 long-term capital gain. That's not part of qualified business income, remember, because gains aren't included. Brandon claimed $25,000 in itemized deduction, and his taxable income was $125,000. We take $100,000 plus $50,000 minus $25,000, you get that $125,000. His taxable income for qualified business income deduction purposes is only $75,000 because we have to reduce the long-term capital gain. But all this gymnastics here, the bottom line is Brandon got an additional deduction of $15,000 because of this qualified business income deduction. And so this is a big deal for agriculture. And so your tax professional should do this for you, or if you're doing your own taxes, make sure that you include this qualified business income deduction. It's really quite simple. You just look at your income, income after expenses, and see if there's any gains, see if there's any gains on asset sales, see if there's any commodity gains, exclude that, and you can calculate this qualified business income deduction. Things like TurboTax and other software will include this for you. So one of the things I did want to talk about, I talk about this with most farm groups, particularly if you're starting out in farming, you don't want to fall into this category of not-for-profit farming or hobby farming. At the bottom of the screen, I have FTG. That's an abbreviation here, maybe a little sloppy here. That's Farmer's Tax Guide. So that's an IRS publication you might want to take a look at. And on page 26 and 27 of the Farmer's Tax Guide, there's quite a bit of detail on this. But if the IRS says you're a hobby, meaning that they don't think you're ever going to earn any money on this business, and there's rules related to this on 26 and 27, they're going to say you're a hobby. You do not want to be classified as a hobby. And so the main thing here is you treat your business like a business, and you intend to earn a profit. If you own land, that's also a account for you in terms of being a business. But the problem here is if you don't qualify as a business, if they classify you as a hobby, then you can't deduct expenses near as much as you can otherwise. And so for the most part, I would think most people in the room would have no problem with this, but it's just something to keep in mind. You do not want to be classified as a hobby. It does happen quite often. They look at, in particular, not picking on an enterprise here, I'm just being frank, they pick on in particular people that own horses. And so if all you have is horses, they'll scrutinize that in more detail than they would if you had cows. Because cows is the IRS, in terms of the IRS eyes, that's more of a business than having horses. And so it's just something to think about. Self-employment taxes are quite large on farms, and so this is something that also you need to consider. The self-employment tax rate is 15.3%. So if you're a sole proprietor and you have income that's not excluded from self-employment tax, that's a pretty hefty tax. 12.4% for Social Security, 2.9% for Medicare. The Social Security is phased out at about $135,000, $140,000. Medicare is never phased out. And so if you make $1 million, you pay 2.9% on $1 million. As if. If I made $1 million, I'd be willing to pay 2.9% of Medicare, but I don't make $1 million. And so let's don't worry about that. One of the places this comes into play, and this is probably more for your retired grandfather than it is for you guys, but it's something that's important to think about. If you do have family members that are retired and renting you land, for example, is they want to make sure that they are classified as not materially participating in the land rental. Why is this important? Because if they can say they're not materially participating, or they're just a landowner and they're renting land to you or your father or both, the income from this rental is not subject to self-employment tax. So this is a huge deal for landlords that are, particularly related landlords that are renting ground to you. They want to make sure that they can say they don't participate in the farm, so that they can they don't have to their rental income is not subject to self-employment tax. This is one of the reasons why you probably have run across before situations where a farm has an operating entity and all the land is owned outside of the operating entity is being rented to the operating entity. There's reasons why you don't want land in the operating entity, but one of those reasons is related to this rule right here. The people that own the land, maybe the same people that are in the operating entity, they want to make sure that rental income is not subject to self-employment tax. And so that's one of the reasons why we see the land held outside the operating entity and rented to an operating entity. And so as your farm grows, or if you already have an entity, this is something to keep in mind. Many people do not want their land to be in the entity. There's a lot of reasons for that, including liability, but one of the reasons is related to what I'm talking about on this slide. We want to make sure that rental income is not subject to self-employment tax, because self-employment tax is 15.3%. And a lot of farmers I know worry more about self-employment tax than they worry about income tax. Because we can use the cash method of counting, and we're growing, a farm's growing, we have tremendous flexibility with depreciation in terms of managing our income, that we're just as worried, if not more worried, about self-employment tax as we are income tax. And so just a quick note on self-employment tax. Now let's talk briefly about business entities. One second here. I wanted to bring up my FSA document one more time. Let me see if there's anything else I want to talk about there. Yeah, before I get into the entities, let me just talk about some transition planning issues that are really important related to taxation that I think I need to mention at this time. Now, if you're thinking about buying land, I recommend always a young and beginning farmer to buy land outside of the family rather than inside of the family. And I don't know if this comes up or not in your situation, but let's say you have a relative, maybe an uncle that's not living on the farm anymore. Maybe he's a professor or something. I rent ground to my brother in Nebraska, so that's why I bring that up. My brother rents ground from me. But let's say that as a beginning farm, you're approached by your uncle, and your uncle says, "Do you want to buy would you like to buy my land?" Your answer should be, "Well, not really. I would rather buy someone else's land that's not a relative." So why do I say that? Well, you already probably control the land, or you're able to rent the ground from the relative. Why in the world would you want to buy ground that they already have control over? And so when you're thinking about buying land, buy land outside of the family, because that gives you more land, a bigger land base, and it also helps you build equity. One of the things that's very challenging for beginning farmers, extremely challenging, is once you have a certain amount of cash, you've made some profits, there's so many different things you can do with that cash. One of the things you want to think about, not right away perhaps if you're just beginning, but one of the things you want to think about is, how can I build equity? because in order to have good relationships with lenders, I've got to build some equity in my business. They're more comfortable lending to someone that has some equity or skin in the game, if you will. And one of the ways you build equity is to buy real estate. All I'm saying is when you buy real estate, buy it outside the family, because buying a family member doesn't expand your land base. And so I'm on my pulpit here a little bit, but that's one of the things I wanted to make sure that I talked a little bit about. And moreover, if you qualify, buy land, buy at least part of the land. Land is very expensive, so the FSA is going to limit how much you can borrow on the land. But look into that. See if you qualify for their beginning farm loan related to real estate. And again, the reason for that is the interest rate is extremely low, compared to what you could get from a lender. The very small down payment, I think the down payment's 5% or something. No lender besides FSA is going to lend you money on land and expect you to pay 5% down. It's more commonly you have to pay 30% down. And so they're much more willing to work with people, that don't have a lot of equity, to lower that interest rate and to have a small down payment. So just some words of wisdom related to that particular topic. Is there any questions on that before I move into entity choice? And I know because I'm not there in person, it's a little harder to ask questions, but is there any questions, anything I've covered, including that purchasing land?
Nope, I think we're good. I think we're good.
Okay, if you do have any questions, my contact information is on the Center for Commercial Agriculture. I work with beginning farmers all the time in some of these transition issues. Do not hesitate to drop me a line. We're not going to cover it today, but in addition to talking about financing, I also talk about dividing business income. I talk about purchasing assets from retiring family members. And so there's just a lot of topics that I address related to transition planning that I want you to check out on the Center for Commercial Agriculture website, but also feel free to drop me an email on those topics. I help people all the time with those topics. And that's one of my favorite jobs at Purdue is helping people think through that, because there's so many assets in agriculture, and it's so hard for the older family members to get out, still have some income to live on, but at the same time, make sure that the younger generation maintains the asset base. And so this is really, really challenging. And with the new administration, it's probably going to become even more challenging, because they're probably going to change some of the rules related to business transfer. I'm not going to say a lot about entity choice, because this is not a huge deal unless you're already part of an entity, and if you are, then you've already chosen that entity. But there is a really good publication that I would take a look at if you before you approach your CPA or lawyer or expert that's helping you with your taxes and estate issues. Before you approach them, take a look at this publication from Iowa State. It's Ag Decision Maker C452 Business Entities. It's really good in terms of discussing the advantages and disadvantages of various business forms. An S corporation and an LLC are very commonly used in agriculture. They provide some good liability protection, but also have a lot of flexibility in terms of putting money in and taking money out of the business. They're more flow through entities, if you will. So it's easy to get money in and easy to get money out. There's nothing wrong with a sole proprietorship and partnership. But once the farm gets a certain size, then the entities become more important. Part of that's related to that self-rental issue I was talking earlier. As the people that operate the farm have a larger asset base, liability becomes more important. You have no liability protection with a sole proprietorship and partnership, and so if something happens to somebody on that operation, you have both business and personal liability. So that's one of the reasons why people go to an entity. But quite frankly, having said that, 90% of farms in the U.S. are sole proprietors. If you don't have hired employees, if you don't have multiple family members, this liability protection is not near as big an issue. It's once you start getting more people in the business, you start getting a bigger asset base. That's when having an entity becomes extremely important. These are all the different possibilities. The LLCs and the S corporations are the workhorses in agriculture today. There's still some C corps out there. In fact, my family back in Nebraska has a C corporation. There is some benefits from a C corporation, but the problem with the C corporation is it's hard to get the assets in and out, whereas the LLC and S corporation, much more flexibility in terms of how those businesses are funded and getting the money out of the business. And you might think, well, what am I worried about getting the money out of the business? Well, there's going to be something as you continue to farm, you're going to have retained earnings. And those retained earnings are think of those as savings that you're going to use to buy land and buy assets. You want a lot of flexibility with those retained earnings. I want to use those retained earnings to buy land. Well, with a C corporation, it might be hard to get those retained earnings out without taxation consequences, so I can buy the land. And so this becomes a bigger issue, as you farm more years and you build up capital. You want to make sure you're able to get that money out so you can buy land, build a house. I mean, just whatever you want to use that retained earnings for. You want to be able to get that money in and out relatively easy. In the C corporation, it is more difficult to do that. So that's why it's not as commonly chosen by small businesses, including farms. Factors to consider with doing entity choice. I've already talked about liability. There's also taxation issues. The one that hammers you is the C corp. You tax twice. You're taxed as a corporation. You're taxed when the money comes out. The other entities are more flow through, so you're just taxed as the money comes out. Liability is a big reason that as the business gets larger, more complicated, more people, you don't want to do the sole proprietorship partnership. And I talked about the fact that some of these entities are more flexible in terms of the capitalization, getting money in and out. Another thing to keep in mind, and again, this is probably more for your grandfathers or your fathers or your grandfathers, but it's something that you need to be aware of too, because this is what they're dealing with. Right now, the estate tax laws are fairly generous for small businesses in terms of settling estates without taxation issues. I realize land is very expensive, but we're talking about some amounts here that are pretty large. My family settled their estate the last 2 years, and we fell well under this, and we had quite a bit of land in the estate. And my in-laws are currently in the process of settling their estate in western Nebraska. Again, they had quite a bit of land, and they still fell under these amounts. And so you can have quite a bit of land and still fall under these amounts. For an estate of descendant dying in calendar year 2020, it's slightly higher than this in 2021. The basic exclusion was 11.58 million. They have something called portability, which allowed the personal representative of the deceased spouse to make an election to transfer or port this 11.5 million to the surviving spouse. And so effectively, if you had a grandmother and a grandfather, you had double the 11.58 million. You had 11.58 million times 2 before the estate was taxed. And so you could have an estate in excess of 22 million, actually in excess of 23 million, and it still wouldn't be taxed. This is something we need to keep our eyes on, because I have a sneaky suspicion, not a conspiracy theory, a sneaky suspicion it's going to change with the new administration. But certainly we hope in agriculture that this doesn't change, because this gives us a lot of flexibility in terms of settling estates without having to pay estate taxes. And even though it sounds like large amounts, if you own substantial land holdings, if you have relatives that have substantial land holdings, it doesn't take that much land to reach these amounts. And so I've kind of talked about taxes here. Any questions on keeping accounts, taxes, beginning loans, transition planning issues? This is your opportunity.
Michael's a great resource, so if you have any questions to pick his brain, please do.
I was just going to ask a question of the group and they can raise their hands. I can't see them, but Abby will tell me, are involved in an entity.
3.
And the rest are farming on their own?
You're involved. What's your guys's? Mm-hmm. He's sole proprietor of the land. What about you?
So some of both?
A little bit of both, yeah.
Okay. Regardless of what your situation is, whether you're joining an operation or you're in your own operation, check out these FSA loans. If you've been farming less than 10 years, that's one of their main criteria. Check those out. And then also really give some thought about how you're going to build equity. What's your strategy of building equity so that I can become someone that the lender is really comfortable in dealing with? And I don't have any answers to that, but at some point you need to think about how to be able to invest in some land if you don't already own some land, and even if you have, even if your family has some land, you kind of want to build some equity on your own, so that when the people that are in your other people in the entity retire, you have some equity yourself in addition to the equity you might be inheriting. And so that's one of the big challenges for a group like I'm talking to this morning is that real important question. What's my strategy for building equity? And you got to be careful there, because if you get too aggressive, as you know, and you get too much money borrowed, that could actually go against you. You got to be really careful too there that you manage your debt. And so I don't have any easy answers for you, but that's something you really have to think about. Is what is my strategy for building some equity so that I can comfortably go into a lender without having to have a cosign from a relative and borrow money. That should be your goal, is to be able to do that in the near future.
Okay, Michael, from a grandfather to a grandson, skipping a generation, how does that work in some of this stuff if we're skipping a generation?
It's really not much different from an estate purpose, estate taxation issues if you go to the next generation or the second generation down.
Okay, so estate taxes and the capital gains and stuff like that.
The grandfather can give that money, he can give his assets to anybody he wants.
Okay.
So that they can do that, and I've seen that happen in cases. I've also seen cases where they split it. The next generation gets some, and then the 2 generations down also gets some. And here we're talking, when we're talking estate taxes, we're primarily talking land. I've talked to a lot of people about transferring machinery. That's something that should be done before the estate. And so if grandfather has some machinery and he's 80 years old, that he really shouldn't have that anymore. And so you need to figure out how can he sell that machinery to the younger family members in a timely fashion that isn't extremely isn't going to cause a lot of taxes for him. And so estates, I usually think that's 2 things: cash, liquid funds, and land. The machinery, green bins, some of that stuff needs to be transferred before you get to the estate. It really does.
Do you have any,
like in a situation where you're not doing that, you may want to give that some thought. How can grandfather that's no longer farming, how can he slowly but surely get rid of some of those assets?
How do you handle that when you have a grandfather who is still farming at 86 and is still active in all of the farming operations and might be a little stubborn when it comes to transferring assets?
Well, one of the things to talk to that 86-year-old about is to tell him that the taxation issues with him selling that machinery in 1 year are enormous. I haven't met an 86-year-old yet that likes to pay taxes on on capital gains, and just tell him that you're going to create a lot of taxes for your spouse when you die if you own all those depreciable assets. And so one of the ways to handle that is and still have the grandfather get paid for those assets. Because I'm not saying give those assets away. You don't necessarily have to give those away. What they can do is they can have the younger generation lease those assets. And so slowly but surely, at least with an option to buy. And so slowly but surely, grandfather will have less and less assets because as the assets are depreciated out, grandfather should not be the one buying the new asset. And so that's another thing to keep in mind is talking him out of doing that. Say, well, no, grandfather, it'd be a good idea if we bought that tractor rather than you buy that tractor. I know this is hard to do because I come from a very stubborn family myself. I know this is very difficult to do, but it is that the 86-year-old, if they have depreciable assets, they've got to end that. And that's the way I suggest doing that is leasing the machinery, the depreciable assets to the younger generation. So they're getting paid for the fact that they have those assets and make sure they're not buying new assets. Because one of the things that happened is that 86-year-old, let's say he had a good year in 2020. He says, I don't want to pay all those taxes. He says, I'm going to buy a tractor. Bad idea. Because if that person dies, IRS wants some of that depreciation back. Whereas if the younger generation buy it, it's not an issue because we're not going to sell that tractor.
Awesome. Anybody else? Questions? Scenarios that you've dealt with or are trying to figure out?
As far as liability goes, is an LLC the best way to go?
Did you hear that, Michael?
Yeah, I think the question was an LLC a good entity? LLC or S Corp. I don't really have a strong preference for either one. The attorney you work through with the paperwork might have a strong preference for either one, but I think both of them are serve similar purposes.
Liability wise, though, is there a difference?
Not very much. If there is, it's pretty small. They both provide liability protection.
Thank you.
The also in the land holdings, I should probably say something about that. It's quite common. It's quite common for land to be held in LLCs. And I asked the attorney why they do this because I'm not an attorney. I don't even pretend to be one. I asked him why is that so common for land to be held in an LLC, and he told me the reason is LLC gives you much more flexibility in terms of what happens to that land when someone dies or someone wants out. And so that's a huge deal. Let's say you had a person on the farm, so an on-farm heir, and he owned land jointly with his two sisters. So let's just say we have an on-farm heir, he's a male, and he owns land with his two sisters. Well, if that land is not in the entity and they inherit that land and one of the sisters wants to sell, guess what? They have to end up selling that land. Unless they can come to some kind of agreement that the on-farm heir can afford to buy it and the sister's willing to sell to the on-farm heir. Whereas if you have an LLC for that land, there could be some documents in the LLC saying how that works. That if sister wants out, the only way she can get out is if the brother or the other sister buys the land. They can only sell to the heirs. And so that's one of the reasons why you see LLCs for land ownership, in addition to an LLC or an S Corp for the operating entity. And so you might have wondered, why do some of these farms have so many entities? There's reasons for that. The entities allow them to do things that they couldn't do if the asset was not in an entity. Another thing you see a lot is you'll see an LLC. It's usually an LLC, not an S Corp. You'll see an LLC for the trucking part of the business. That's for liability reasons. Is we've got people driving those trucks. If they hit somebody in town, we want to make sure that our liability is limited to some extent.
Thank you very much, Michael. We really appreciate you.
You're welcome anytime.
To talk
Feel
with
free to
it.
send me questions. Take care. Have a good day.
All right, thank you. Hey, Patrick, if you are on and ready, I will
am.
turn it over to you.
Appreciate it. Good morning, everyone. I'm going to go ahead and share my screen once. Oh, I think you have to let me do so there.
I
Abby.
do. I do. Forget about that.
Okay. Well, good morning, everyone. My name is Patrick Williams. I'm the manager of the Farm Bureau Health Plans. We just passed legislation this time last year to be able to offer health coverage to our membership. A good portion of our membership is involved in the agricultural community, and the two biggest concerns they had were price, because as we all know, the ACA is fairly pricey coverage, but also two, they wanted to make sure that they can get attention, medical attention, to more than just that small geographical location that they're limited to with an ACA plan. So fortunately, we were able to meet those expectations, if not exceed them, with what we're offering, which I'll discuss with you today. So with health plans, we have 4 different traditional plans. So for those under the age of 65, from top to bottom, we've got the most comprehensive plans, our Advanced Choice and Classic Choice, to our major medical, which again, many of you may be familiar with that term, also known as catastrophe coverage, which basically means that you have higher deductibles and higher out-of-pocket expenses. But again, all of these plans are not considered insurance, primarily because we medically underwrite. And in today's insurance definition, you cannot medically underwrite and deny people to be deemed insurance. Fortunately, though, for us, we're typically going to be 30 to 50% less than an ACA plan for an individual plan, and then 50 to 70% less for a family plan. All these plans look, act, talk, even walk like insurance, but again, they're not considered insurance primarily because of our medical underwriting. They all come with preventive care, maternity benefits. We have a nationwide network. We are covering the COVID vaccine. Again, these are very, very good plans available for our membership. We also have standalone dental vision plans. Our Advanced Choice and Classic Choice plans have a dental vision built into them, but again, for those that maybe have an employer that doesn't cover any dental or vision, or you would like to couple any of our plans with it, we can also do that. It's through Delta Dental as well as VSP. Doesn't look like any of you are really needing the Medicare supplement plans, but again, for any family members that are approaching 65 or over 65, we definitely have those Medicare supplements available. Again, with Medicare supplements, what their main purpose is to cover the extra excess costs of Part A and Part B of Medicare. So unlike the ACA, we allow our members to join throughout the year with no enrollment windows. So it doesn't matter if it's the beginning of the year or the very end, you can come on board at any time. All of our plans begin and end on the first of the month, so it's pretty simple to remember. Anybody can get a quote by going to infbhealthplans.com, but you do have to be a member for at least 30 days before you can submit an application. That is a state statute that we are required to fulfill. Now, when it comes to getting a quote, we've made it as easy as possible. I always encourage you all, if you have a Farm Bureau agent or you'd like to reach out to a local Farm Bureau agent, they can certainly help you as well, guide you through the process. Otherwise, if you prefer going direct, you can go directly onto our website to apply or receive a quote. Or you can also call in and talk directly to a representative. Again, those representatives can coach you on what plan best works for you, as well as help fill out an application over the phone. Our website, too, does have a really great Guide Me feature. So if you're not overly familiar with healthcare or the various different plans that are offered, just want a little bit of guidance, that's a great way to go. We do allow you also to check to see if your doctor's in network, too. So again, we try to keep as much information in front of you as possible. Now, from an eligibility standpoint, really just two big ones. You have to be a resident of Indiana, a primary resident of Indiana. That doesn't mean that you can't live elsewhere, but for tax purposes, you have to declare that you are a primary resident of Indiana. And you do have to be a member of Indiana Farm Bureau. As I mentioned earlier, there's that 30-day wait period for all new members. The membership is $32.50 per year. We do have some medical underwriting. If you are over the age of 40, there may be some additional steps that you have to take. But again, being a resident of Indiana, maintaining a Farm Bureau membership, and our medical underwriting, which could consist of just filling out an application to providing medical records depending on your age. Those that can be a part of your plan include your current lawful spouse, natural, adopted, soon to be adopted stepchildren, as well as those that you have guardianship over or legal custody. So again, pretty expansive there. All children are able to be covered under the plan until 26. They can then transition over to their own plan without any additional underwriting or obstacles in that regard. Now, some of the benefits of these plans, as I mentioned earlier, we are 30 to 50% less for individuals and 50 to 70% less for families when we compare ourselves to the ACA. Unlike the ACA, we do have some significant differences from them. One being portability. If you do move throughout the state of Indiana, you don't have to worry about reapplying or adjusting your coverage. This plan will follow you anywhere you go. You can also apply at any time. It's open enrollment throughout the year. When it comes to our nationwide network provider, we have partnered up with United Healthcare's Choice Plus network. What that means is we cover 95% of doctors and hospitals in the United States. So an ACA plan, you are geographically bound to your location. And if you go outside of that network, then you start paying higher co-insurances, usually about 40%, which means you'll be paying 40% of your bills from the doctor or hospital, and you will have no cap on what you'll pay out. So one of the complaints that we had from our membership is those who are needing to perhaps go outside of network to see a specialist in Chicago or take their child to see a specialist in Philadelphia or Cincinnati. All of them were running into potential financial ruin because, again, every bill that they had with an ACA plan would be 40% with no cap. So with us, we wanted to make sure that whether you're traveling, you want to seek medical attention because of a specialist somewhere else in the United States, perhaps if you have children who are getting education outside of that small network, you're not going to run into these massive financial expenses. From a customer service standpoint, we have a top-notch representatives that are available 8 to 6 Eastern Standard Time, Monday through Friday. Again, if you have any questions on what plan is best for you, where are you in the application process, you need to turn in a claim, all of those things can be answered with our 888 number. Another benefit too, there's a lot of stuff on the open market. With health plans, we only underwrite you once. Once you're in permanently. And that will be your base rate for the entirety of your plan. Fortunately, you can request what we call reconsideration, which means you can apply to get a better rate with your current plan. That does not mean you'll get a worse rate if the medical records or anything that you show is to your detriment. You can only improve your rate. So if you perhaps lose some weight, no longer need to take certain medications, etc., we're always allowing you the opportunity to improve your rate, which is significantly different than what's on the market there. One of the other big complaints off market too is that if you file claims, am I going to be canceled? Which, again, all those short-term plans on the open market, if you file too many claims or your health deteriorates, they are going to non-renew you. With health plans, we don't do that. Once you're in, you cannot be canceled unless you stop paying your bills or you don't renew your annual Farm Bureau membership. So you will always have a place with us. So again, that's a really powerful message for those that are wanting to transition away from their current employer. Now, from an underwriting standpoint, as I mentioned, we do have some steps when it comes to medical review. From an application standpoint, it can take anywhere from 15 minutes to 60 minutes, and just depending on the size of your family. If you're young and single, you'll probably just check no's all the way down and it'll take you less than 10 minutes to fill it out. But if you have a little bit larger family, you could definitely hit the 45 to 60-minute mark. If you're over the age of 40, we do require medical records. From that standpoint, we just look at blood work, height, and weight. As long as you've had somebody take that within the last 12 months, we'll accept it. If you haven't had a physical within the last 12 months, which many of us haven't, you can simply just, again, go to your doctor, a Minute Clinic, walk-in clinic, Farm Bureau Life Insurance through our paramedical exams satisfies this requirement as well. So there are multiple ways of getting it. When it comes to actually from start to finish, we'll typically get a decision for you anywhere between 15 to 30 days. Again, that's assuming that you're providing the medical records or submitting the application and not having any additional follow-ups needed. But for the most part, once you submit it and send the medical records in, you just simply wait for a decision. From a billing standpoint, pretty straightforward. Everything's due on the first of the month through automated bank draft. We do allow up to a 20-day grace period if you miss a payment or forget to update your banking information or maybe fat finger something when you're keying it in. If you do miss the 20-day grace period, the plans do cancel, but you can reapply at any time, no penalties or anything that's carrying over from the former plan. The call center and website, the website is going to have all the forms and resources necessary. If you want to inquire a little bit more, learn about our plans, or get a quote for that matter, we also have all the forms necessary to endorse a plan. Again, our call center, I can't say enough about them. They do an outstanding job from start to finish. From a claim standpoint, in case just so you understand how we operate, Farm Bureau Health Plans is the underwriter and the customer service side. But from a claim standpoint, that's where United Healthcare and UMR, their third-party administrator, are in the background processing everything. We wanted to make sure that if you filed a claim, you wouldn't be sitting on your hands waiting. So they get things done pretty efficiently in the background. I wanted to provide a couple of examples just to highlight exactly what our costs are. So I have two examples here. The first one here is our Advanced Choice Plan, which is the most comprehensive plan that we offer with Ambetter Gold's plan. Again, you'll notice that the deductibles are pretty similar, relatively speaking, $2,900 versus our $1,500. Co-insurance is at 20%. If you're not familiar with co-insurance, once you pay your deductible, you will pay 20% of whatever medical bill that you are receiving until you hit your max out-of-pocket expense, which in this case would be with Ambetter Gold, $12,600 versus ours at $10,000. So an easy example would be if you blow out your knee, you would pay with Ambetter Gold $2,900 immediately. And then as those bills come in for whether it's rehab or surgeries or whatever, you would pay 20% until you had a max payment of $1,200-$600. So with a family of four, ages 35, 38, and 6, Ambetter Gold is $2,004. Again, they just have one rate based on the age. That's what you get. With health plans, because we do medically underwrite, we have four different categories that we have. Our preferred category, $571, so almost $1,500 in savings, as well as our basic category at $713. About 65% of those who apply for us fall into these two categories. But as you'll note, even if you get our highest rating, we're still saving you almost $700. So again, significant differences. We're approving about 85% of those who do apply, by the way. Now, you'll note too that as the family gets a little bit older, the disparity between health plans and the ACA plan with Ambetter gets even greater. So 45, 40, 25, and 15, Ambetter Gold is $2,351, will range anywhere from $626 to $1,466. So again, that was one of our goals too, is to make sure that as the families age, they're not having skyrocketing costs. Here's an example of an individual plan. Again, comparing ourselves with Anthem Bronze versus our high deductible health plan, HDHP. So again, different age brackets here. I'll focus on the 55-year-old. As I mentioned earlier, one of our goals was to be able to have that transition for somebody who is wanting to retire, getting close to retirement, but can't because their current insurance scenario does not allow them to do so. With health plans, we make sure that we are actually being able to offer them a financial plan, or we can make it financially feasible for them to achieve a plan. So a 55-year-old with Anthem here is 861. We range anywhere from 260 to 731. Again, that cadence will continue all the way until age 65 as well. So very feasible options. We've got 4 different plans, each with 2 different deductibles, if not 3. One thing to note too is that after the second person on a plan, we stop rating unless there's major pre-existing conditions. So a family plan of 2, 5, 7, 10, etc., will all cost the same. So that's where we see our significant savings for our family plans, because again, we do not rate after the second person. Also, children under the age of 19 cannot be declined. They cannot be rejected. They will have coverage immediately. These are very family-oriented plans. Lastly, I'll just touch on the Farm Bureau membership. Again, it's $32.50 per year to be able to have access to our health plans, but you also get access to all our insurance products, as well as legislative, agricultural support and representation. You also get a plethora of various different discounts ranging from hotels, restaurants, vehicles. Currently, right now, we've got a pretty good discount coupon for Ford pickup trucks as well. If you are interested at all in taking a look at the various membership benefits, visiting infb.org is certainly, I would encourage you to do so as well. So with that, Abby, I'll throw it back over to you. If there are any questions, comments, concerns, be happy to address them. Whoa.